Hello everyone, it's been a while. One of my largest current opinions on commodities involves oil, as I've been posting about somewhat regularly for a while now. And there's one very simple reason for that, which is significant backwardation in the forward curve that has occurred exceptionally recently, but has also trended upwards over the last few years. And as you'll see if we look at recent spread charts, that despite the war dissipating, the curve remains exceptionally backward regardless. And this is very important because while the cash chart of oil looks like this, the chart of an oil position's performance looks like this. A very, very significant difference because you're being paid so much to be long the commodity. And if we look at a longer term chart of this, we can see why this is so important. Because if we toggle off back adjustment, the chart looks like this. And if we toggle it back on, it looks like this, which allows us to look at a couple different zones of history where through the 80s and 90s, prior to the top in 2008, oil was significantly backward before it fell into contango over the next decade or so, and we are now back into backwardation, potentially leading us into the next bull market. If you're unfamiliar with forward curves, backwardation, and contango, they're pretty simple. The forward curve is simply a visualization of the contract prices of a futures product over the upcoming contracts. So, for instance, if the front month contract of August 2025 is at 66, December is at 63, and next June is at 60, you're getting paid 3 points to be long, as I would say, over those periods, because if the cash price of oil in this case was to stay at 66 for the next 10 months and ended up at 66 by June of 2026, that would mean that the June contract of 2026 has to catch up to that price as time progresses. So I think an easy way to say that is that you're getting paid that amount across that amount of time to be long the product, assuming that cash stays the same. Now, obviously, there's some implication that this is implying mean reversion, but the way that I was taught to trade and think of this is that it is generally a bullish indicator because if the underlying is to increase, if cash is to go up, then you're getting paid to be long while the underlying is going up. And in terms of how your position is profitable or not, this is very often the difference maker, as I'll show you. So for right now, this is roughly how it looks with front month at 67, December at around 63, and next June at around 62, meaning that if cash prices of oil are to remain the same into December, the back end contract will have to catch up about 4 points across that period. So for you to lose on a long position in December, oil has to drop around 4 points by then. And why this matters, here's a great example. In September of 2022, on the back adjusted chart, oil is unchanged. On a cash chart, oil is down about 10 points since then. So we've gotten paid around 10 points to be long oil because the curve is backward, and as a result, we are flat on a trade we would be down on if we were just looking at a cash chart. However, if we look at this period of time from July of 2009 until the start of 2020, the cash chart appears unchanged, while in reality, if you were long oil throughout this period, you would have lost a significant amount of money because throughout this period, oil was in contango and you had to pay to be long. And preceding this period was another period of backwardation, being the 80s and 90s, where the back adjusted chart looked phenomenal into the top, while the cash chart was actually flat the majority of this time. So in all three of these cases, the difference between profitability and significant loss was the forward curve. And now, after around 10 years of contango, we have finally gotten back into a backward curve where we're getting paid to be long. And not only that, but we are in backwardation at a time where we are around the average price of the last 20 years or so, which means that at the mean price of the last 20 years, we're still getting paid to be long, which is very significant because in general, commodities do trend higher, and we're also, as some would say, due for a general oil bull market as we have now traded at these levels for 20 years. So this brings up two situations. One, as the natural order of things would suggest, at some point we enter a new bull market, and now that we're seeing an indication of backwardation, as we saw in the 1980s and 90s before the last bull market, we may be entering a new one, and even if we aren't, you're getting paid to be long, which is a great benefit in commodity positioning. And while it is true in oil, it is also true in many other commodities. For instance, in wheat, prices have actually gone up since 1970 rather significantly, though they're relatively unchanged over the last couple decades. In reality, wheat longs look like this because it has been in contango the entire time. Or something like soybeans has gone through a couple distinct cycles of contango, backwardation, back into contango, where in all instances the real chart differs very significantly from the cash chart, and in determining a position's profitability or loss, it is one of the most important factors. And it is also often a leading indicator. Like in coffee, for instance, where for 2 decades we only saw contango until we finally saw backwardation over the last few years, and that was the time to start getting long. Especially as we looked at a back-adjusted chart of this, it was only really losses until we entered backwardation, from which the bull market began. As was the case with something like soybeans, where it was only time to get long once that front end really started getting above that back end. And as we can see in the cash chart, we're unchanged across this period, but because of that backwardation, had you been long, it would have been a very profitable ride. So as we look back at oil, and we look at some of these spread charts, especially current front months, you are seeing that backwardation really pick up to levels we haven't seen in a while, and it puts us in a very interesting position where, as long as this remains true, and we continue to see that the front months remain well above the back months, and that the spread charts act well, it may be very reasonable to look for long positions in the commodity, because you're now at a point where you're at that 20-year mean, you're getting paid to be long, and you're in a situation where you don't necessarily know what the next narrative is, but you do know that you are seeing things that have preceded rallies in the past in this commodity and in others. And at the very least, if you're wrong, you have that buffer that you didn't have prior, where now you're getting paid to be long rather than the opposite. So in general, a lot of things are starting to look positive here, and I figured it would be something nice to talk about. Now, there's more to pay attention to rather than just these front month contracts, which are looking phenomenal right now. There's also how the current back end months, which will become front end months, are acting relative to their back ends, which has been less than perfect recently, but you'll notice that it's still positive. And if, for instance, cash prices stay the same, and December makes it to August's current price, you'd like to see the pink line here of the ratio between our December and next December's prices get back up around its highs to prove that we're still in that backwardation. So your indicator of whether or not to stay in or leave this trade is whether or not this persists over the coming months. If we start to see an oil rally and these spreads don't rally or they end up flipping, that's a great sign that, hey, I've made my money and I need to get out. Or if you feel some pain but the spreads are holding strong, that might be your indication to feel like, I'm still getting what I want out of this, I'm going to hold on a bit longer. So in general, with all of these things, spreads are very often your leading guiding indicator of whether or not you'd like to still be in the position. And if things start to improve and you see the spreads improve, then you know, hey, this is a good trade. This is something that I want to keep my eye on. Keep in mind, this is just my opinion piece on these things. This is just my personal view of commodity markets. But as of right now, it seems like a very interesting opportunity is appearing in oil that hasn't been here in a very long time. And it's certainly at a point where it's getting very interesting. And if you're watching this wondering what's a way to position on this, if you can't trade futures, USO is actually based, I believe, on front-end futures, as you'll see in its long-term chart. It's very poor. It's certainly different than just being long the oil contracts, because those charts can appear negative in some instances and such, which has interestingly poor reactions for this, as you can see in the chart here. But with that backwardation does come outperformance versus cash oil, which you haven't seen in USO in forever, and everyone's kind of written it off because they're not used to backwardation oil, but we're now actually seeing it. And if that remains true, as you can monitor with the spreads, then USO should outperform cash oil, just as a back-adjusted chart of CL futures would. So keep that in mind, and obviously just pay attention to how this is reacting to oil price changes compared to the back-adjusted chart of CL futures. And if it's not following as you'd like to, exit the position, obviously, because you don't know why that is. Otherwise, it should generally match that chart pretty well, at least going forward, assuming there's no massive crash. But this generally would be an acceptable way to position for it, as long as the curve remains backward. Otherwise, as I might do, just be long the December futures contract, and if the back adjustment stays into that contract and it ends up being a couple points above next July, then maybe you hold it if you still like it. but that would be my indication to continue with it. And that's about all I have for you. That's my opinion on oil right now and CL futures, and why I think that perhaps you're entering a new bull market, and at the very least you're in a situation where you can actually find some profit long oil that you haven't been able to find, it seems and feels like, for a very long time. That's about it. Thank you for watching. See you next time.